Hi, everyone.
Not in here. It goes on live.
Oh. I told you. Asterisk, not good with technology. How's everyone doing? Good, good. Awesome. So first and foremost, pat yourself on the back. This market, right? It's great, right? Great interest rates, a lot of inventory. Yeah, it's the best, right? Right. So first and foremost, definitely pat yourself on the back for coming, educating yourself, because at the end of the day, this is your craft. This is what we want to do. Whether you're helping other people's buy and sell, whether you're trying to invest in yourself and create generational wealth, why are you here, right? So remind yourself, why are you here? Are you servicing others? Or are you servicing yourself and your family? But at the end of the day, you're servicing something, right? That's what real estate is, and that's why I love it so much. I am a business development sales and marketer for MBH Settlement Group. We're one of the largest, if not the largest, settlement company here in DC, Maryland, and Virginia. We are also licensed in 29 other states. So there's no excuse why you should not use us for any settlements. We do land, we do commercial, we do residential, we do investment, we work with wholesalers, we work with hard money lenders, we work with conventional lenders, we work with buyers, we work with sellers, we work with agents. We work with anyone that has anything to do with buying real estate and selling real estate. So I have over 20 offices within the region here, DC, Maryland, Virginia. I'm from Baltimore to Richmond to Virginia Beach to West Virginia. I'm in the car only a few hours a day. But it's my passion. I can talk about real estate and title all day long. So today we want to present 1031 Exchange. We have an internal company called Principal 1031. So I have my most amazing settlement manager, Kathy Tate. She sits in our Stafford office, but definitely covers all closings when it comes to Woodbridge, Manassas, Stafford, Fredericksburg, and beyond. She's here to present our 1031, Principal 1031, and I'm super blessed to have her as my partner.
Hi.
Thank you. And so please get with me, again, Julie Turner. My email is jturner@mbh.com, jturner@mbh.com. I have some business cards. I have some swag. First and foremost, I want to help you get the deals before it's even ratified. So yes, I want to work with you at the settlement table to get your settlement closed. But what I do mostly is I partner with my agents, I partner with my people, and I say, what do we need to do to get yourself out to your sphere of influence to get this business and to close these deals? So love to meet with you one-on-one. Please come up to me and Kathy before the end of the evening, and love to work with you. So thank you so much.
Thank you. All right. This one? All right. So Kathy Tate from MBH Settlement Group. I've actually worked for MBH for 19 years. I have worked in the Stafford office for 19 years. It's my home, away from home. So I was 11 when I started. She just turned 31 yesterday. So truly it's a passion. Title is a passion for me, and I'm super excited to be here and would love to speak with any of you all after the meeting tonight. So thank God for Ryan. Ryan is here tonight. He's going to kind of help. He's speaking after I am, but I'm going to talk about 1031 exchanges. I'm going to give you enough information to get you like really intrigued about it, and then pass off some of the questions to Ryan and kind of go from there. So 1031 exchanges. Whoops, where am I supposed to go? Sorry. Right.
Also, you're all going to get a copy of this entire slideshow, so if you miss anything,
Right click is there.
left click.
So, this was right?
No, you do the left.
Oh, gotcha. Okay, I was like, I swear to God, this is
No, you do the
right.
left.
Gotcha. So, what is a 1031 exchange? So it's for investors. It's for people who are business owners making money. It's for people who just have investment properties. Anybody who is gaining, making money on the property. You could look into doing a 1031 exchange. So I always say for realtors, you want to keep your ears open when you're listening to your sellers, and if they're an investor, then pass on this information to them. So we're going to talk a little bit about this. property that you purchase in exchange. So it's an exchange of a like kind of like properties. So like properties, you're exchanging the properties, and the reason it's a 1031 exchange is so that you don't have to pay your capital gains right away. It's a deferment, it's not eliminated. So wouldn't that be nice if you could eliminate capital gains and never pay them, but you're gonna have to pay them, it's just deferred. All right, oh, I did it again. Somebody take this for me, when I say thanks, click, click. See, it's not me, you guys. Okay. So it has to be real property. And what is real property? Well, real property is whatever the state deems real property to be. And so it can be land, it can be a hotel, it can be a condo, it can be just a house. So real property is what we deal in. I think everybody in here knows what real property is because we all have something to do with real estate. So it's real estate property. Maybe we can go to the next one. Okay. So the IRS is going to tell you that you're going to have like-kinded properties. So you're going to give up relinquish a property, and you're going to purchase a property, all like-kinded. So like-kinded doesn't mean you have to have land. So say you bought land as an investor, you were looking forward to maybe building a hotel on it or something years down the road, and it didn't work out. So you want to sell this land and purchase something else. You don't have to have it to be land to land or land, it can be land to a condo, it can be land to a house, as long as it's investment. So it has to be an investment to an investment. You also want to make sure that it's the same price of your proceeds. So whenever you go to relinquish the property, you know, you've got your sales price and you've got your commissions and all your normal seller costs. That's going to be your net sales price. So when you go to purchase or obtain a new investment property, it has to be the sales price, 100% of your proceeds or more. So you can't, but you can do multiple also. Yeah, yeah.
You can trade down too with some of the tax.
Yeah, yeah. So this is.
Deferral, equal or more.
So you always have to spend equal or more. And there's just what I kind of just said, raw land can be exchanged for an office building, an apartment building. The IRS has kind of made it pretty broad for investors so that it's very user-friendly for you guys. So the next slide. Okay. So we've got this guy, Mr. Starker, that in 1979, he decided to interpret the IRS laws for the 1031 exchange and the regulations. So he sold his investment property, and he took those proceeds and put it in an escrow account. And he just left it there. And then when it came time to do his tax returns, he did not file for his capital gains. So the IRS didn't agree with that because he was interpreting that, the then rules for the 1031 exchanges, and he didn't pay those capital gains. So the IRS disagreed and they slapped him with capital gains, and they charged and sent him a bill for the interest and penalties on that property, on his proceeds, and sent it to him. So this guy pays it, sends it in, but then he files a claim for a refund to the IRS. And the IRS said, once again, I don't agree with you. You know, he's interpreting it one way. The IRS is saying, no, you let it lapse too long. So IRS denied the claim for a refund. So then this guy sues the IRS. And the IRS lost. This gentleman won because the rules, the regulations, all of these things weren't laid out enough for the IRS to say, hey, this guy was wrong. Therefore, now we have all these rules that the 1031 exchange has. So you can't hold on to the property for a year and not pay capital gains. So now we're gonna go over some of these rules, strict rules that they have. And stop me with questions. Ryan's here, he's a CPA, and he deals with investors all the time. And I always go, the first thing you're gonna tell your seller or buyer potential for a 1031 exchange is there's two people. He's gotta talk to a CPA. They gotta make sure it's even worth, you know, is this something that's gonna help you? The CPA is gonna know that. And number two, the 1031 exchange company is very important too. So,
Qualified intermediary.
yep, there
Don't
you
start
go,
it
QI.
without getting them in place first.
So what are the benefits? Well, here's the benefit. You're gonna have more buying power when you go to buy if you don't have to pay capital gains when you're relinquishing your investment property. So now you have more money, you have more capital. Don't pay those capital gains, so you have more capital to purchase more on the other side. So it's smart. And if you're a business owner, if you're a business person, you know that it's smart to be able to, yes.
So I just want to, and again, does everybody know what capital gains is?
Yes.
Okay,
Yeah.
just want to make sure.
Got it, hope so, right. I mean, I'm assuming too.
Okay, all right.
So it is a huge, I mean, if you're paying capital gains, you're paying 37% on capital gains. That's a huge chunk of money. Why not defer that capital gain and take that money and invest and get more for your money?
Well, you get 37% short-term capital gains, long-term are a bit more preferential, but they vary depending on income bracket. There's still gonna be, it could be up to 20% plus the net investment income tax, surtax on top of that. But short-term could be top marginal tax, or whatever your marginal tax rate is.
And thank you.
Yeah, no problem.
Yeah. So does a contract, when you're writing a contract for a 1031 exchange, I actually had a realtor call me 2 or 3 weeks ago, and she had a 1031 exchange buyer, and she didn't realize that she was supposed to put a contingency and clause addendum in the contract. So this is so when you go to write a contract, if your seller is a 1031 exchange or your buyer is buying with a 1031 exchange, you absolutely have to put in an addendum, contingency and clauses, and there's actually a little section in the contingency and clauses that says this is part of a 1031 exchange. The reason you want to do that is because the buyer or whoever the other party is, they have to sign documents for the 1031 exchange company. They have no tax, repercussions or anything, but since we have our QI, the 1031 exchange company, they actually sign the ALTA, they have things to do with the closing. So the other party has to be aware of it. And if you don't put that in the contract, and then all of a sudden you're saying, hey, it's a 1031 exchange, well then you haven't provided the right documents, you don't want any problems. So, but the agent had no idea that. But so, that's why it's nice to learn these things as a realtor or as an investor about these 1031 exchanges. So yes, the 1031 exchange company is definitely part of the process. No. Can the taxpayers navigate 1031 exchanges without, you absolutely must have a 1031 exchange company, a QI, or an intermediary as part of this. You just can't do it without it. That's, you absolutely need it. And then always, seek a professional. I'm going to keep going over and over saying your CPA. If you're a businessman, you're going to have your CPA. He's going to be able to tell you whether or not it's worth it. Why? That would be you. Why it wouldn't be worth it? That would be you.
It always depends on the individuals, but you want to check before you don't want to start the 1031 and find out later you don't qualify. Always check up front.
It's super important. It is common as a title company. I see it quite often. I have quite a few investors that they'll sell off, and within that 45 days they write 3 different contracts or something with their exchange property. So it's out there, it's used, it's a great tool, but it's not for everybody, but it's something that you can let your clients know about. And of course, who is the qualified one is you can't be yourself, you can't have a family member, you can't have your CPA do it, you can't have your finance guy do it. It's only a qualified QI. Then, so as part of the closing, when I'm sitting there and the seller is doing a 1031 exchange. So on the seller side, I kind of can break down what the alt is going to look like. So you're going to have your sales price, then you're going to have your commissions, then you're going to have all your normal settlement costs, and then there's a line that says 1031 exchange, and all of that money is going directly to the 1031 exchange company. So what they're doing is they're holding the proceeds. It's not like the seller can hold their own proceeds. It's going directly to the 1031 exchange company. Yes.
Scenario. So if I purchase a home and I sell it in 9 months, and I gave 1031 exchange at the end of the calendar year because I sold it in the 9th month. But let's say once I get an extension on the 1031. So let's say I'm working on a property and something falls through and it happens in January. Let's say by the time we actually conclude that this is no longer a good deal, it's in February and I've received my gains. Will the IRS then consider that as a long-term or short-term? Because technically I didn't touch money for the year.
So you started when did you start the exchange?
I started the exchange in the 9th or 10th month of the year because
So
I sold it after 9
As long as you own the property at least 12 months and 1 day by the time you receive the property.
I sold it in the 9th month, but I
Yeah,
didn't
but,
touch the funds.
so you don't have constructive receipt until the qualified intermediary releases those funds to you. So after it fails. So when you sell the property, the money goes to a qualified intermediary. You can't touch it.
Right.
So the qualified intermediary holds the funds, so you don't have constructive receipt. So 12 months and a day need to pass before you can ever touch those funds, which would be when they release it to you. So if 12 months and a day passed, that could be long term. Otherwise, it's going to be
So
short.
it's technically long term. So if I was to receive, the deal was to go through, my gains would be considered technically long term.
Yeah,
Because of how the transition.
and that's if they release it to you like on a rate. You can't tell them yeah, look, you gotta wait another month. And then it's long term. But if that's the way it plays out, and the intent was you went into it full intent to close on time, make this 1031 exchange happen, and that's just kind of how the dice rolled out. Then
Right.
yeah, it would be long term. It would be when you have receipt of the funds.
Right.
Awesome. Great question. Yes. Yeah. How much tax is deferred? I'm going to let you talk about
Yeah,
that.
so it'd be all of your capital gains plus depreciation recapture. Does everyone know what depreciation recapture is? Yeah? Okay. No? So depreciation, which we're going to talk about in a minute, it's an allowance that you get these deductions the IRS gives you based on the purchase price of your property. Recapture, when you sell a property, you're basically recovering those deductions. So you have what's called your basis in a property, which is generally your purchase price to start. When you take depreciation, that's your adjusted basis. When you sell a property, your gains calculated by the selling price minus your adjusted basis. Selling expenses. So an example would be, let's say you bought a property for $100,000, something in Northern Virginia probably. And you take $20,000 of depreciation over however long you own it. And let's say when you sell it, it's worth $130,000. You're going to have a $50,000 gain, 130 minus the 80,000, which was your $100,000 purchase price minus the $20,000 in depreciation. The recapture is going to be the $20,000 gain that's attributable to the prior depreciation. And it's taxed a bit differently than capital gains. So it's taxed at ordinary income rates. They cap out at 25% when you're dealing with real estate, and then capital gains are usually 0, 15, or 20% depending on your income tax brackets. So you kind of have a bifurcated gain to deal with. So 1031 knocks out both of them.
Can you talk a little bit about the best time to own a 1031 exchange is when you die?
Oh yeah. So so basically it's called you'll hear people refer to it as swap to drop. So you buy a property and essentially you keep trading up. And then when you die, there's a section in the IRS code that allows all your assets. The applies to real estate, but also applies to things like stocks and bonds. They get a step up in basis. So whoever inherits your property, you could have paid $100,000 for it 40 years ago, and when you die, it's worth $1 million. Your heirs take that property when it's worth $1 million, and let's say it's a productive investment property. Their depreciation resets on the new $1 million valuation. They pay no tax on everything you've deferred throughout your life. So you can keep deferring. Yeah, if you really want to stick it to the IRS, die.
That's great advice.
Does that also include if you have your investments in a trust?
Is it a revocable living trust?
There you go.
Yes.
Oh, yeah.
Living trust.
Yeah, revocable living trust is kind of a disregarded entity. The IRS kind of use that as like a part of you, like a single member LLC.
Right.
So that's going to be fine. But if you would put it into like an irrevocable trust, that's a totally separate vehicle and different rules apply.
Then that doesn't apply.
Yeah.
Yeah, and I see a lot of 1031 exchanges with trust all the time. So yes, that's a great question because a lot of people are putting everything into a trust. But yeah, I see that all the time too. All right. Well, we know the requirements already. Kind of, you know, it has to be you're investing as much as you just got in your proceeds. So it has to be at least the same exact amount of your net proceeds. Also, it has to be like-minded or like-kind properties, which now we know is basically anything that's real estate. They don't dictate it. So, and then a little bit about the boot, which I called the boot taxes. Yeah.
Yeah, so if cash is involved, if you receive cash in any way, that portion will be taxable.
Yeah. All right. And this is, and I was also, and this is why, by the way, I'm presenting this. I kind of wanted to get you interested in enough to reach out to our 1031 exchange company and get some information from your CPAs. If you don't have a CPA, you really should get one, and Ryan's super knowledgeable. But I was going to let him talk a little bit about the ownership and that it can't be an LLC, and so it's specific to the kind.
So the exchange has to be, it's whoever's on title of the old property essentially needs to be on title of the new property. So where you can run into issues if you're in a partnership situation and some partners want to cash out and others would like to 1031 exchange, you can't 1031 exchange an LLC interest. There's ways around it. It's one way is called a drop and swap, where essentially you take the real estate, drop it out of the LLC into a tenant in common. So each partner owns a tenant in common interest, and then you can 1031 that. However, that's really expensive to do. Might work when you're dealing with big numbers. You don't want to deal it. You're not gonna. It's not gonna pay off to try to do in smaller deals. So just kind of an FYI there. It's doable, but not for everyone.
So what would you suggest? You want to pull out of an investment?
You gotta.
For another investment, but you want to have the taxes deferred.
Well, everyone has to agree. So it's the LLC that does the exchange, not the individual partners. So they basically all need to be on board.
All right. And then the next slide. Talking about. No, you can't be related. You can't have the buyer as your sister, mother, brother, cousin. Parties all have to be unrelated. It's sort of like a short sale. It has to be able to pass the arm's length transaction question. And so that you can't have somebody as part of your family. And then when can you write a contract offer on your replacement property? Anytime. You can write a contract on your replacement property before you've gone to settlement on your relinquished property. So you can do that anytime. And then the next slide. And can you purchase in a 1031 exchange before you even listed your relinquished property? And yes, you can. It's called a reverse exchange, and so that's a whole nother set of rules and regulations, but it's out there just so you know. If your investor finds something and they want it there and then, and they want to purchase it with a long as they've talked to their CPA and the qualified intermediary and they all sounds good, go ahead, don't let it pass. So don't let that stop you guys from investing and purchasing, because there's another way around that. And then the company can help you with that. But the biggest thing, I mean, what I see of most of the 1031 exchanges are with in trust, with people that have, you know, personal monies and they want to invest and they want to get the most for their money as they're getting their replacement properties. So it's a really great tool. There's a lot to it, so we always want to make sure that you use the professionals. Like I said, MBH has their own company, their 1031 exchange company that can answer any specific questions. I just wanted to get that out to you, but also I just wanted to say, if you guys have any real estate closing needs, 19 years of working in the same office at MBH, I freaking love what I do. I love title. I love making sure everybody gets to closing. I travel for closings. I mean, I am just in love with what I do, and I love helping people buy and sell, and I love agents, and I love helping them with their business. So, I could talk about title all day, just like Julie could probably talk about helping you guys. So please, please feel free to reach out to us at MBH. And thank you, Ryan, for helping me so much. Pick his brain. Pick his brain and pick Julie and I's brain too when it comes to your settlement needs.
Any 1031 questions?
Yeah.
Go ahead.
Ryan, do you want to come up here so that they can watch on video? No.
What happens if you don't find other property in time?
Yeah, so there's actually two timing rules. You have 45 days, so for the time you close, 45 days to identify your replacement properties. Generally, you're going to identify up to 3. You do that, you submit it in writing to your qualified intermediary. Then you have 180 days to close. It's 180 days, 100 calendar days, for the due date of your tax return. That's sooner. So if your 180 days goes past April 15th, file an extension. That way you can utilize the whole time period if you need it. If you don't close in 180 days, it's a sale. So the property. Yeah. Anyone else?
When you 1031, can you go into, does that have to be, say you have $100,000, does that have to go on one property, or can you do like 2 or 3
No,
properties?
you can spread it out.
You can-
Actually, yeah, you can spread it out. It's just, if you want to completely tax deferred, the proceeds from the relinquished property need to entirely go into the new property. So that's going to keep it completely tax deferred. You can trade into as many properties as you want. So like I said, it's normally 3. You can identify 100 if you want, but then when you get over 3, you have to close on 95% of them in order to complete the exchange. So it's you don't see that very often. But yeah, you can go to the one.
Yeah, 2 other questions.
Yeah.
And then it's, again, say you've got a bunch of money, $1 million, you want to build your dream house. The 1031 money doesn't include, you can't include any construction costs, I assume, right? Like say you got $1 million for 1031, you pay 200 for the land.
There are ways to do that. It's not as straightforward. You can kind of put it into, you would basically need to get a construction fund involved with the intermediary and still meet the timing deadlines to close.
Oh, that's true.
Yeah, so it's 180 days. So I guess theoretically, you could start construction and close on what's there, then you'd be paying out of pocket for additional costs. So doable, but difficult.
Okay. And the last one, can you 1031 into a syndication, it sounds like, as long as you're on title?
Well, no, so the syndication, doable, again, but difficult. So the syndication would have to, so they're going to have the syndication, the LLC over here, and then they have a tenants in common where the syndication is one of the ticks with the person doing the 1031 exchange. So yeah, it's going to add a bunch of additional legal work. Usually, if you're going to 1031 into a syndication, then we're going to require big dollars to do it, but it's doable.
You might still say taxes on it.
Yeah, more money. Anything else?
I just did a 1031 exchange, but we haven't closed on the house that we're selling. This is a new build. But the thing is, I sold the house for, let's say, $80,000 more. So now she has more money than the house that she's purchasing. But it's a new build, so they're gonna finish in March 8th. It's the deadline, 180 days. So now she's like, what will I do? I'm buying this in cash, but I have about 120 extra. So I told her like, we'll roll it over to another property, but then I can, right? So it's
Yeah, you
like,
can do that, it just all has to be in that 180-day time.
yes, so she can do 2 properties.
Yep, yeah, exactly.
One fully paid and the other one is,
Yeah,
let's say,
partial,
a bit.
make up the difference. Just close in that time window.
You said within the first 45 days, you have to write the contract like that?
Yeah, you have to identify your property. So you close on your property, you sell, money goes into the fund, the qualified intermediary. Within 45 days, you have to tell them, look, I'm gonna close on one of these 3 properties. Typically it's 3. And that, one of those properties has to be what you complete the exchange with before the 180 days. So basically, best practice is like when you start to
If you don't
convert
give
an
them
exchange, find those
another-
properties, try to close on it as soon as possible. All right, anyone else? 1031? All right, good deal. There's,
Oh, I got it.
yeah,
You want it?
all right, so now we're gonna talk about depreciation, cost segregation, and then self-directing your IRAs. So depreciation, we touched on a little bit, basically, you're allowed a deduction to recover your investment in business assets and investment assets. Sometimes you're gonna hear this referred to as phantom expense or non-cash expense, because you're never gonna write a check for depreciation. It's based on the IRS, what they tell you the class life of the asset is, and you basically spread your costs out over that time. Depreciation is what allows real estate investors to have positive cash flow and at the same time show a loss for tax purposes. Depreciation is not optional. The basis in your asset is reduced every year by the amount of depreciation allowed whether you take it or not. That means you can't skip it to avoid depreciation recapture. We touched on that earlier. Recapture is the gain that's attributable to the prior depreciation that you took. And tax on recapture is at ordinary tax rates. Real estate caps out 25%. Capital gains have more favorable tax rates. You want to have more of the gain tax, capital gains rates. Because of that, the IRS doesn't let you skip it. Now, if you've missed depreciation, you haven't taken the wrong amount, then the IRS considers this the adoption of an incorrect accounting method. And you can fix that by filing Form 3115, change in accounting method. Basically, that allows you to kind of go back in time, pull forward all that missed depreciation, and take it on your tax return. So I'll see this a lot. Clients that have been self-preparing, maybe using TurboTax or something, and somehow they answer something wrong, and the software's never calculated depreciation. Then they go to sell the property and have this big depreciation recapture that's being taxed. And at that point, so that's when you'll file 3115. It basically lets you go back and pull forward all those years. You're not restricted like with amending the return. You can only go back 3 years. This lets you go back to the place in service date and record all that depreciation. So common types of depreciable property. So there's all sorts of property out there that can be depreciated, including farm animals. And we're talking about real estate. So the key 3 categories are your buildings. So residential real estate is 27.5 years. So you buy a building that's residential, depreciated over 27.5 years. Commercial, non-residential, depreciated over 39 years. Then we have these things called land improvements. They're 15-year property. It's like fencing, landscaping, swimming pools, drainage systems. These are improvements to the land around the building, but they're not actually part of the structure. And then you have personal property. This is the 5 and 7-year property. Things like appliances, carpeting, equipment, depreciate much quicker than the building and the land. You also have land. So you buy real estate, you're buying a building, land improvements, personal property, and land. Land is not depreciable. So when you purchase a piece of real estate, the first thing you need to do is allocate your purchase price out between the land and the building and the other components generally. 3 of the most common ways to do this are in the sales agreement. So you can stipulate in the sales agreement the allocations of purchase price of the building to the land. So
typically, the buyer gets a higher allocation to the building because they get depreciation. The seller wants a higher allocation to the land to avoid recapture. So they're adverse parties. When the IRS sees adverse parties, they generally respect whatever agreement they come up with. This is more common with larger properties. Second way is to have an appraisal done. That costs money. Third way is you use the property tax records. This is the least best way to free up here. But honestly, it's what you see most common, especially with single-family properties. You buy a property, you look at the property tax records, get the assessed value, what's the percentage of land in that assessed value to the overall assessed value. You use that applied to your purchase price. That's typically what I see most common with single-family homes. Now, how do you calculate depreciation? First, you want to determine what your basis is. Your basis, purchase price, including closing costs. If you put any capital improvements in the property before you place it in service, you don't include those as well. Then you determine out of that basis what's depreciable. Land's not, so you allocate that out. So, as an example, let's say you buy a residential building, it costs you $400,000. You have $10,000 in closing costs, and $90,000 in improvements. This was needed some work before you got it ready to go because the service, did the value add deal here. Let's assume your land was 20% of the purchase price, found on the property tax records or whatever. Take 20% and apply that to the purchase price only. So 20% of $400,000, $80,000 allocation. Don't allocate any land to the closing costs or improvements, only to your purchase price. So that leaves $320 to the building, adding your closing costs of $90,000 improvements, and $420,000 depreciable basis. It says it's residential real estate, so that's going to be depreciated over 27.5 years. So instead of depreciation, 27.5 years, give you just over $15,000 a year. If you have an asset that you're not sure what the class life is, IRS publication 946 has a pretty long list in there, so you should be able to kind of nail it down to something close to what you're looking at.
One of the Facebook questions was accelerated depreciation. Are you going to touch on that?
Yeah. Next slide. So those bonus depreciation is what they mean when they say accelerate. So there's two types of what I call special depreciation. That's not a real IRS term. It's bonus depreciation and then Section 179, which we'll touch on next. So bonus depreciation applies to property with an asset life of 20 years or less. So that's going to cover your personal property, that 5 and 7 year property, land improvements, your 15-year property like fences and landscaping. This other category called qualified improvement property, also a 15-year property, applies to improvements made to the interior of non-residential real estate placed in service after the building's been placed in service. Now, certain exclusions to that are enlargements to the building, elevators and escalators, and then anything dealing with the internal structural frameworks, I think internal load-bearing walls. So this QIP, Qualified Improvement Property, QIP, whatever you want to call it, this was actually sort of a patchwork to the Tax Cuts and Jobs Act. When they passed that in 2017, they inadvertently took leasehold improvements, qualified restaurant improvement property, and qualified retail property, which were always 15-year property, so meaning they were eligible for bonus depreciation, and it inadvertently took them back to a 39-year class life. So with the CARES Act in 2020, they added this qualified improvement property category to fix it, sort of a patchwork, if you will. So now this is also all eligible for bonus depreciation. So basically, bonus depreciation, all it is, it's a percentage that you apply to the cost of an asset that allows you to write off that percentage of the cost in year one. So from late 2017 through 2022, it was 100%. Meaning if you went and bought an asset that had a class life of 20 years or less, you can expense the entire thing in year one. 2023, this year, it's 80%. Next year, it goes down to 60. And then 2027, it eventually goes to 0. That's assuming Congress does nothing. I suspect they'll change because we've had some form of bonus around since the early 2000s. It's like 30%, then 50. So this bonus depreciation is pretty huge. We want to see it come back. Oh, shoot. Let me do this. That's fine.
you can't hear. I'm like, what? Sorry, technical difficulties with those people watching on live.
They didn't tell them they need to come.
Yeah, say it in there. You need to be.
You need to be here. All right. All right, now I can't get it. All right. Okay, that should work, hopefully.
Yeah,
All right, so next we have Section 179. So Section 179 allows for the immediate expensing of qualified property placed in service during the year. 2023, you can expense up to $1.16 million. That's an inflation-adjusted number, changes each year. So this is a 100% write-off. Like bonus this year is 80%. Section 179 is 100. However, it has some additional limitations. Must be an active trade or business. So when you're dealing with real estate can be an active business or it can be an investment. It depends on how active you are in the business activity itself. So it has to be an active business to use Section 179. If you have an investment property or two with a property manager, odds are it's an investment, you can't use Section 179. However, the main reason you see bonus depreciation used more often than Section 179 is Section 179 cannot create a loss. Bonus depreciation can. So bonus depreciation can create a loss or increase a loss, where Section 179, it can take your taxable income down to zero for that property, but it can't create a loss. So any unused Section 179 depreciation would be carried forward to the next tax year. It doesn't go away, you don't lose it, but it's not going to create a loss. A lot of times you want to be able to create the loss. It also is it's not used for buildings, but neither is bonus. It cannot be used for land improvements. So that 15-year property, the improvements around your building, you can use bonus depreciation on, but not Section 179. Next one. However, with Section 179, we have this category called qualified real property. This, again, improvements to non-residential real property. First thing under this categorization is qualified improvement property. That QIP we talked about with bonus, also eligible for Section 179. In addition, you can Section 179 roofs, HVACs, fire protection and alarm systems, and security systems. But again, this is only for non-residential real property. Next one. I think we missed one. Go back one. Anyway, so, okay, there's supposed to be a cost seg slide in there. So with cost segregation, we're kind of shifting out of depreciation to cost segregation. So cost seg studies, everyone know what that is? Does anyone not know what cost segregation is? So a cost segregation study, it's an engineering-based study that reallocates a value that would normally be classified as part of the building, 27.5 or 39-year property, and it allocates it to personal property and the land improvements. When you buy a building, you're buying land, the building structure, the personal property that comes with it, and the land improvements. So a cost segregation study identifies a value for each portion of that building. So without a cost seg study, you go buy a building, you're going to have, on your depreciation schedule, you'll have land and building. Building is going to be depreciated over 27.5 or 39 years. With a cost seg study, you're going to allocate about 20 to 30% of that building value. So take out land, now we're left with building. About 20 to 30% of that cost is going to go into personal property and land improvements. One of the best things about reallocating that cost to those shorter asset lives is quicker depreciation. And in this environment, you still have bonus depreciation. So you're able to use bonus depreciation on those shorter asset lives. So here we have an example. Let's say 2023, you buy an apartment building that has a building value of $1 million, excluding land. Normally, you would get a $36,000 or so depreciation deduction. So it's $1 million divided by 27.5 years. However, let's assume you have a cost seg study done, and it allocates 25% of that building cost out to 5 and 15-year property. You got $150,000 to 5-year property, or $100,000 to 15-year property. Completely ignoring bonus depreciation, that changes your depreciation deduction from $36,000 to $62,000, so an increase of about $26,000 in year one without bonus depreciation. However, this was bought in 2023. We have 80% bonus depreciation, so you'd write off 80% of that 5-year property and 15-year property in year one, plus the $27,000 for the remaining $750 allocated to the building structure. So rather than a $36,000 deduction in year one, you take a $227,000 deduction. So that's what having a cost seg study does for you, especially in this bonus depreciation environment. Another thing, just if you bought a building, let's say in 2020, one of those years where 100% applied, and you haven't done a cost seg study, you can have one done now. They will allocate out the building value, and on your next tax return, you'll file a 3115, that change in accounting method we talked about, that works for misdepreciation, and you would get the 100% bonus depreciation because it goes with the year the building was placed in service. So if you have a building out there you placed in service, never did a cost seg, think you can benefit from it, you can essentially go back in time and do it on your next tax return. Another place that cost segs work is breaking out those assets, regardless whether you can take bonus depreciation or even deduct the losses. Let's say you're a dentist, you invest in real estate on the side, and you're like, I'm never going to deduct those losses. I carry my losses forward every year. I don't care about the accelerated depreciation. There may come a time where you end up depreciating the same asset twice on your depreciation schedule if you don't have a cost seg study. And the example I'm using here is with roofs. So in 2005, let's say you buy a building, no cost seg study, land, building on your depreciation schedule. Well, included in that building cost is the roof and all the other building components. You're just straight lining this over 27 and a half or 39 years. And here you are in 2023, you need to replace that roof. So you pay for a new roof, you capitalize it, and you're going to start depreciating this new roof over the same 27 and a half or 39 years. You're essentially depreciating two roofs at the same time. With a cost seg study, can you go to the next one? With a cost seg study, you can write off the old roof because there's a regulation out there in the Treasury Regs 1.168, whatever that says, I don't have it memorized. It's called a partial asset disposition. So basically, what this allows you to do, if you replace a roof on your building, you can write off the undepreciated portion of your old roof. If you have some value assigned to the roof, what that is, you can't make it up. The best way to determine that is to have a cost segregation study done. It's going to assign a value to that roof. So when you replace it, there's going to be some portion, if it's less than the 27 and a half or 39 years, that's undepreciated. You can write that off as a disposal loss under the partial asset disposition rules. So now when you capitalize your new roof and start depreciating it, you only have one roof. If this is a non-residential building, we had that thing called qualified real property. One of the things you can use Section 179 on is a roof. Theoretically, if you have the income to absorb Section 179, you could write off the partial asset disposition and the new roof in the same year and really enhance your deductions, assuming you have the income to justify the Section 179 deduction. So there's benefits to the cost seg study that go beyond just the bonus depreciation, which is like kind of the hot thing now. All the cost seg studies I see now are based around bonus depreciation. There are other reasons to have it done, simply to have those assets broken out. Now we're going to talk about the self-directed IRAs. So anyone in here self-directing? No? Or kind of? So a self-directed IRA, all it is, it's an IRA that you get to choose what you invest in. So typically, your traditional IRAs with Fidelity and Vanguard, they want you invested in the products that they sell. So stocks, bonds, and mutual funds. They're not going to let you invest in real estate or other alternative assets. If you self-direct, you can invest in real estate using your IRA funds. However, there's certain rules you need to be aware of. Now, these rules apply to every IRA out there. There's nothing special about a self-directed IRA and any other IRA other than you choose what it invests in. So these rules apply to every IRA. You're just likely not going to run into a scenario where you'd violate them in a IRA that's invested in mutual funds. Generally, you're going to need a company that specializes in self-directing because Vanguard's not going to do it for you. So the first rule is you have what's called prohibited investments. So the prohibited investments, rather short list, it's collectibles, life insurance, and S corporation stock, and then anything that constitutes a prohibited transaction. So it's the prohibited transactions that trip people up when it comes to self-directing your IRAs. The investments are short list, prohibited investments. Next one. So there's a list of what's called disqualified persons. Your IRA can't invest with a certain group of people. So the prohibited transactions prohibit with whom your IRA can invest with, rather than the investments that they can invest in. So you have the IRA owner, your spouse, lineal descendants like kids and grandkids, ancestors, parents and grandparents, and then any businesses that you control 50% or more of, or you in combination with any of the family members on this list control more than 50% or more of. And then in addition, the key people in those controlled corporations also disqualified: officers, directors, other greater than 10% shareholders.
Can you do a self-directed and like a SEP IRA at the same time? Or?
Yeah, so the IRA, and you get, just like any other time, whether it's self-directed or not, you can have two. Just your contributions are different between the SEP and the traditional. You can self-direct a SEP. But if you want more bang for it, you might want to consolidate them, roll one into the other, and then invest. So there's three types of prohibited transactions. First, you have the per se prohibited transactions, which this is any sort of transaction your IRA engages in with anyone on that list of disqualified people we looked at. So transaction means buying or selling of goods, lending money to, borrowing money from, any transaction. You can't transact with people that are disqualified, basically your family members. I don't know if you noticed, but on that list of disqualified people, they don't have in-laws, they don't have brothers and sisters, they don't have cousins. The IRS might not be worried about you working out special deals with your in-laws, I guess, but it's only the people on that list. Second type of prohibited transaction is called an extension of credit prohibited transaction. So basically, your IRA can use leverage to buy assets, but you can't guarantee the debt. You can't guarantee it. You can't secure it with your personal assets like your primary residence. Your IRA wants to use a non-recourse loan. It can be secured by the property that your IRA owns. Often that's going to involve using a special lender to facilitate it. And then we have what's called self-dealing transactions. So this is when the IRA owner or one of the disqualified people engage in directly or indirectly benefit from the use of one of the assets. So let's say your IRA owns a sweet beach house you're using as a short-term rental. And you're in the area, it's not rented out, you're going to go check on it. You can't stay there, or that's a prohibited transaction. This one falls under the self-dealing transaction. So personal use of assets owned by your IRA are prohibited transactions. Even things like what we'd call sweat equity. You're just going to go in and do a repair on your property. Can put you in a position where you're going to violate the self-dealing rules. So the IRS looks at that as an indirect benefit. That's probably one of the dumber IRS rules out there, but it is a thing and can get you in trouble.
If you get caught?
If you get caught, yeah. But here's what happens if you get caught.
You ever stayed here? No.
So if you get caught, what happens if you as the owner enter into the transaction on behalf of your IRA, the entire IRA account's distributed, taxable, and if you're under 59.5, then you're going to pay the 10% penalty. Now, if you're self-directing a Roth IRA, all your contributions still come out tax-free. They went in after tax, they come out tax-free. So the tax and the penalty would be assessed on the earnings only, but then you also lose all that future growth. If a third party engages your IRA in a prohibited transaction, like your financial advisor, it's only the amount of the transaction that's distributed, but I've never seen that happen. It's always the owner, or they direct their custodian to do something. So it's always the owner that does it. I've never seen a third party do it because they tend to know the rules better. Last part, so in an IRA, so an IRA is all it is a trust. It's a special type of trust. So sometimes your IRA may be subject to tax, and it's going to be taxed at the trust tax rate. So the trust tax rates are the same as the individual tax rates. They're just at a very compressed set of rates. So the top marginal tax rate of 37% for a trust kicks in at about 15%, or $15,000. That's 37% on 15,000 and up. So not ideal to pay the tax. As always, if the only way to get money into a deal is to use your IRA, run the numbers, see if it works. So the two types of tax are UBIT and UDFI. So UBIT is unrelated business income tax. UDFI is unrelated debt finance income. UDFI is technically a subset of UBIT. So UBIT applies when your IRA receives ordinary income, as opposed to normal investment income. So by law, interest, dividends, capital gains, royalty income, and rental income are exempt from UBIT. Ordinary operating income is taxable. So if your IRA owns an operating business, that is going to be subject to these UBIT tax rules. Now, a way around that is you can use what's called a C blocker, operate the business in a C corporation that's owned by your IRA. You're going to pay the C corporation tax rates, but that's going to be better than the trust tax rates. That's one way around it. And UDFI comes into play when your IRA uses leverage to purchase an asset. So let's say your IRA buys a $100,000 rental property. It puts down $60,000 and borrows $40,000. It's 40% leveraged. So whatever income that asset produces is going to be subject to the UDFI, these trust tax rates, on 40% of that income. So if your rental property produces $1,000 of income, your IRA's rental property produces $1,000 of income that year, $400, using our example, where 40% leverage is into play, is going to be subject to these taxes. Not the end of the world, just something you need to consider if you're going to go this route and use leverage. Now, a way around UDFI, 401ks are exempt from UDFI when they buy real property. So maybe you roll your IRA funds into a solo K if you have an operating business and self-direct your solo 401k. You don't have to worry about UDFI. And if you are subject to either one of these, you file a Form 990T. Generally, your third-party administrator for the IRA account is going to handle that for you, and you report the tax and pay it on that form. And that's it. Any questions? None? All right, good.
That was enough.
Yeah. If you have any, just I'll be around for a while, so feel free to just find me and ask.
It's interesting, but it's a lot.
So I would highly recommend, if you need an accountant, you're in the real estate space, set an appointment, talk with him, and he can get you to, it'd be easy, yeah. It's a lot of different, everyone's situation is different, so one thing I've learned. So it's best to set an appointment, have him look, I don't want to pimp out your time, but have him look at your stuff. So, I don't know what these slides are. I don't know what I'm talking about, so I'm going to get rid of all this. All right. So no, they weren't. I don't know what they said, but I don't feel comfortable even reading it. So, so yeah, this is, at the end of every meeting, we like to say, what was your aha moment? Did y'all learn anything, that changed the way that you think? Anyone want to say something they learned today? Or share what they learned today?
Oh, yes, I learned, and I actually was talking about this right before I came here, about the solo pay versus the 401k.
Yeah.
That was interesting.
Oh, okay, awesome.
That was good.
Perfect, yeah.
I will tell you that door prizes. Everyone gets a free beer on us, and then we can come get a pie. Just one. If you give me enough, I get.
He gets pretty loose with the tickets.
I've heard.
So, if you're interested in coming, just come to one of us later. Let us know. We'll give you the QR code. You go on the Eventbrite, sign up for your pie, and we'll have a pie for you on November 21st. So you can take it to your
family for Thanksgiving. Next steps with our group especially. If you're not part of the Facebook group, we're just Rich Potomac on Facebook. We post a lot of information, deals, the wholesalers in there. We post a lot of good stuff in there. People ask questions, networking. You do have to answer some questions. If you don't answer, I will decline it. So just answer the question.
I don't know you decline.
Yeah. We do have a YouTube channel. It's goodinvestor.com. We do record all these live, and then we do email it out in our monthly newsletter. So if you haven't signed in on the sign-in sheet, please sign in, put your email in on there. We send out newsletters, we send out deals with also our buyers list. So if we get deals that come to us and we're not interested in them, we do email them out to anyone that's interested in them. So please put your email on the list if you haven't gotten that already. And my favorite thing is next month. Wait. All right. Wait. Free Grid Pass is basically a free website that has all the grid masterminds, YouTube videos, not just from our community, but the owner Rob Chavez. He posts a lot of masterminds and videos in there, and all the other groups' videos are in there. There's slideshows, or all the slideshows from all the presentations are in there. So this is a completely free resource for you. I recommend everyone just go to it, create an account, and go. There's a lot of information on there within the grid community. So next month is our Christmas party. We are going to be at Not Your Average Joe's at Stonebridge from 6 to whenever. Please RSVP, but it's not like this. It's just going to be more of a networking party. We do have drinks. And I do want to tell everyone that if you have any wins, if you have any deals, any stories that you'd like to share, just let us know or send us a message on Facebook or text us or call us. We'd love to know them, and we want to share that with the group. We love sharing different wins within the group. Anyone who's had great deals, great stories, bad deals, anything. We'd love to share with everyone. And that's it. Thank you.